Good afternoon, everybody. Thanks very much for joining us. We've got a fascinating session today, and you're joining us live in Frankfurt, and we've got a superpower roundtable here to discuss both the implications, I suppose, of the recent German elections, but also the general outlook for the market. If you've got questions, you can use the Q&A or the comment buttons, and we'll make sure that we answer those questions during the session. That's one of the joys of the live stream being live. Really interesting panel here, and I'll introduce those shortly. But first of all, we're going to just have an introductory presentation from Markus Sielebeck, who's Chief Urban Economist at Patrizia, just to kind of, I suppose, put some of the trends that are happening in the market and some of the key numbers as he sees them, and that'll act as an introduction just to this session. So over to you, Markus.
Thank you, Richard. Also, welcome from my side. I will make it short, so I don't want to keep it too long for the discussion, because I think that is the much more lively part of it. But maybe to start off with, I think what we can say right now is normality is more or less at the doorstep. We are not back to normality, but normality is approaching the doorstep. We are seeing on the mobility side, we are approaching pre-pandemic levels. And also the distressed fears that were present in the first lockdown and also a little bit over the last summer, they didn't materialize. So we don't have a financial crisis 2.0, and we are seeing mobility returning. So there is a way forward that the market seems to behave in a much more normal way. The only question right now is, how would that new normal look like? Because I think what we all learned over the last 18 months, we will not return to something that is 2019 in 2022. So the market will be different going forward. And one of the differences we will definitely see is that the return outlook, especially when you look at bonds and equities, is fundamentally different to what we are used to in history. So we're still living in a low-rate environment, and looking at whatever the central banks tell us right now, the likelihood of significant interest rate rises, especially when we look at Europe, is very limited. In the Eurozone, that the ECB will rise interest rates this year or next year, I think the probability is very close to zero on that. So the return outlook on everything that is interest related will be quite low. And the challenge resulting from this can easily be presented when we look at that slide that presents US data. So it's not one-on-one comparable to what we see in Europe. But it tells the story of a dying asset class when you be a little bit of cynical, namely because of the dying asset class of bonds. Because for a pension fund and insurance company, if you lead current income to pay, because you have payout requirements, looking for bonds is possibly an ever more challenging environment. In Europe, that is still, you don't see that change in full swing in Europe, and that's because of regulation. There, again, we see how important regulation is, because a lot of insurance companies, pension funds are still required to hold a large amount in bonds, even if they return negative. But the story overall is, going for bonds is for most investors not the world where they want to be today. And focusing on real assets is one of the areas where investors are going to. And if you look at real assets in general, or real estate in particular, and then have a focus on what do they return compared to a 10-year government bond in Europe, then you see quite heavily, even if we see that yields for real estate are at record lows, because the pandemic has proven, as it has not been a distressed environment, that yields compressed further if you're not being in high street retail or in shopping centers, for instance. Maybe even in the hotel space, no trades took place, so the yield compression was not really taking place. But what you see is there is a decent premium over government bonds, and that offers a compensation for the limited liquidity, but it offers you the opportunity to have an income stream and to have a stable and predictable income stream if you understand market fundamentals. So I think one of the lessons of the last 18 months have been back to fundamentals in a certain sense, understanding what drives my real estate, what drives the return side. And this, you can say, is nicely mirrored in what institutional investors are thinking of the market. So core is again the most favorite style investors want to go for. It's not as high as it has been during the financial crisis, because it is not a financial crisis 2.0. It's a much different environment, and the governments have done a lot to stabilize the markets and the fundamentals. But core is still the place to be, and value add in today's world is heavily is suffering from the insecurity about the outlook. Because how will secondary locations, outdated assets, how will they look like in the future? What do we have to do? Do we have to invest? Do we have to redevelop not to core, but maybe to ESG, to social, to environmental? So do we make a value-add positioning to green or whatever? So we still have to figure out how that future will look like. On the other hand, the pandemic has shown that mobility is an issue when it comes to transactions. The dip in transactions is definitely due to the fact that DD processes were prolonged. It wasn't that easy to look at a building. If you had a platform across Europe, it was easy, otherwise it's challenging. At the same time, some sellers thought, should I sell now and where to reinvest my money? So also the the offer declined. But we see with, as I mentioned at the beginning, normality approaching the doorstep, transaction volumes are picking up again. And you see on the bottom side, we're talking a little bit about the German market. Germany performed quite well. The dip in German transaction activity was quite limited compared to what we have seen in some other markets. And that has also to do a little bit with the fact that we have quite a deep institutional internal market. And a lot of German investors in the past year refocused on their home market because that was also the easiest place to visit assets and to buy assets. If you're not allowed to travel to Asia or the US, it's much easier to go from Frankfurt to Hamburg or to Münster to visit an asset and buy it. So at the end, if we look forward and take Germany a little bit in perspective, what we can say is Europe is definitely lagging the recovery we've seen in some other regions, especially in, let's say, the US. And China might be questionable given the current developments we see there and in the stock market, especially also the real estate sector. But overall, Europe is still lagging these developments. And if you look at Germany on the growth perspectives, it's somewhere in the middle of the pack. So it's not a stellar outperformer, but it has been a very stable performer over the last 12, 18 months due to the social systems we have. And that is something investors like. If you look for core, boring investments, stability is possibly the best you want to go for, and that Germany delivers. And what you also see is if you look at the size of the countries, most of the big countries are still less dynamic than Germany, to say it in a certain way. France, UK, Italy, they're all to the right from Germany. So they have lower growth outlook than Germany. So even if Germany is only in the middle of the pack, it's the best performing country of the bigger European countries. And having said this, the bigger European countries means also the bigger markets. Because going for an outperforming Ireland, it's quite nice, but the investment market is much more limited. Going for Norway, it's the same. It's an expensive, limited market. And if you're a European investor, you possibly also add a currency risk to it. So that also says Germany is quite well positioned despite all the struggles. Okay, we can say now we have an election and have to learn how to deal with a three-party coalition, but I think I'm quite confident that Germany is able to do so, and we should have a government a little earlier than we had last time. Nevertheless, there will be a challenge forming that going forward, and we will see that the real estate markets overall will be influenced by what's ongoing. And we can be quite sure that regulation is something that will favor high on the agenda of politicians because it's not very costly. And it creates, at least on the cure of symptoms, an easy win in a short period of time. So I think this is maybe in a nutshell the outlook where we are. And now I'd like to hand over back to Richard for the discussion and the panel.
Great, thanks very much, Markus. Really interesting there, and some interesting points to pick up, I think, for the panel. I didn't introduce myself, so very briefly, and we'll introduce everybody, and I'll lead by trying to make this as short as possible. My name's Richard Betts, and I'm the publisher at Real Asset Media, and we run about 60 or 70 of these events. I'm delighted to be back live in person in Frankfurt. Thanks very much, Carsten, for hosting us here at Linklaters. And thank you for joining us online as well. Let's start with introductions. Maybe just starting briefly with you, Thomas, and then we'll work our way around.
Yeah, thanks, Richard, for being here. My name is Thomas Freit. I'm a partner at PwC in Frankfurt and leading the real assets industry here in Germany, focusing on real estate as well as on infrastructure.
Super. Oliver.
Yes, I'm Oliver Platt, a managing partner of Acida Advisors, which is a newly established NPL advisory platform in Germany, which believes not in a big distress in Germany, but at least in the return of normal NPL ratios with the banks of around 5%.
Super.
My name is Tobias Schultheis. I am the founder of Blackbird Real Estate Group, which will be turned 10 years in 4 weeks from now. We are a transaction advisory company and also an investment boutique focusing on what we nowadays call stranded assets. We have offices in Frankfurt, Munich, and Cologne, so we can cover the whole of Germany.
Great. Ingo.
My name is Ingo Gläser. I'm head of commercial real estate financing for Münchner Hypothekenbank, a 125-year-old cooperative mortgage bank, and I'm happy to be here.
Thank you. Philip.
Hi, Philip Bach. So I'm with Kingstone Living and Care and heading the transaction side. Maybe just briefly, Kingstone Living Care is the new arm of Kingstone, focusing merely on the healthcare assets. So I think it's going to be quite an interesting asset class to talk about today as well, because we're a little bit less impacted by what we've seen today and more by other trends. So happy to talk about that.
Great. Thanks. Rainer.
Hi, I'm Rainer Nordengesser, representing International Campus Group. ICG is developer, investor, and operator in the student housing sector. And we are currently amongst the leading platforms in continental Europe.
Super. Thanks very much. Philip, yeah.
Yeah, Christian Kabel. Thanks very much, Brian, to be here. I'm representing Colliers International here. I'm head of capital markets. We are a brokerage and advisory firm with over 450 people in Germany, and very exposed to everything what's happening here in the economy and the real estate sector.
Great. Carsten.
My name is Carsten Doll, real estate partner at Linklaters. Happy to host you today. I think it's the first live event in 18 months in this office, not only in real estate, but in total. So very happy to have you here.
Yes, and definitely the first live event that I've been to in 18 months. And who would have thought equally that the main issue I faced was not actually getting here, but was putting petrol in my car to get to the airport this morning. Marcus, over to you.
Yeah, Marcus Sillebeck, Chief Urban Economist at Patrizia, real asset manager, focus on Europe, but with increasing global reach.
Great. Thanks. Stefan.
Yeah, I'm Stefan Hoffman. I'm managing partner at Imall Invest. We are a boutique advisory firm advising domestic and international investors investing in the asset class of retail. And Richard, really great to have you back in Germany, and I'm really glad to contribute to this event.
Thank you. Matthias.
I'm Matthias Meckert, Head of Legal Continental Europe with PGIM Real Estate. PGIM Real Estate is one of the big five global real estate investors for real estate and real estate debt.
Super. Carsten.
Carsten Quehl, I'm a director at Carlyle's Pan-European Investment Team, mainly focusing on the German-speaking markets, but as well on the Netherlands and Ireland.
Perfect. Thanks. Michel.
My name is Michel Anter, managing partner at Acida Advisors, colleague of Oliver Platt. Thank you.
Great. Thank you. Christian.
Hi, my name is Christian Sully. I'm founder and managing partner of Waterway Investments. We're a brokerage and advisory firm focusing on non-core real estate with regards to transactions, debt brokerage, and capital solution/fundraising.
Great, thanks very much. So, as you can see, we've got a really interesting group covering a number of the different sectors and also a number of different areas, including the financing side as well. Carsten, maybe just picking up with you, if there's any points you want to pick up on from the presentation, do. But just looking at the election results, for those who may be watching it from elsewhere, who don't necessarily focus on the German election system constantly, just tell us, I suppose, where we're at the moment in terms of your view on the election here.
who knows? But to be very honest, I think the outcome of the election is more positive than I think the press covers it. I think the left wing, or extremes on the left and on the right, both suffered. So that's a good sign. And I think the constellation that we have, not only two big parties called Volksparteien, but also the Liberals and the Greens, is a sort of normality. That's what we see in all other European countries, maybe except for the UK and the US, but they have different systems, political systems. But so I think that's the new normal. It reflects a bit the diversity of the people. And I think they can find a proper government. Hopefully it doesn't take them so long. And I think the rest is normal. I mean, the Social Democrats were down. They recovered, which is the sign that this is still the election for a chancellor and a person, which is understandable. And the Conservatives suffered from exactly that situation. So I think what we see is interesting. It's a bit new, but it's the new normal. And I think we will get a government. And I think politics is it's always politics. It is what it is. It doesn't change what we have to do here and what we do properly. So I think we will go on being a stable market and a stable country. So rather positive.
Okay, great. And Thomas, maybe coming to you, I suppose what's your take of that in terms of the real estate side? Do you see any implications for it, or is it too early to tell? What's your sense of that?
Well, first of all, comment to Carsten. I fully agree that we will have hopefully a stable government and coalition. These are established parties. And if you look at the political programs of each of the parties, I think there are two topics which are in every program and which will come to the agenda. One is residential, to relax the residential rental situation, especially in the urban areas, which is a problem not just in Germany. It's around the same theme around the globe. But you have to try to influence the market, not by capping rents, as we have seen in Berlin especially, and I'm not a lawyer, but it was illegal what they have done, and economically we have seen that it has a negative impact on that what you wanted, because nobody rented out the apartments anymore, so there was a further push into the market which was not planned. So residential will be a hot topic, so we hopefully see some subsidies, some further movements to motivate investors to construct more residential apartments. That's the one topic. And of course, every party had this on the agenda, but the Greens especially, it's about the ESG topic. And that's sometimes also a conflict with increasing construction activity in residential, because you don't want to use additional land. You have to increase, you have to improve the cities, you have to invest significantly in the overall infrastructure, not just residential, but it has to comply somehow with the ESG rules, and that will come to it's on the agenda, and it will get an additional push, which is good and great from my point of view.
Great, I'm going to pick up that in a minute, but I just wanted to introduce Marcus as well. Able to join us, and I know you've got a hectic schedule and you may be in and out, Marcus. So, but just a brief introduction of yourself and the company, if you could.
My name is Markus Poth. I guess quite a few people know me. I'm a developer from Frankfurt, head of Pekin Development company, just finishing or doing projects here in Frankfurt and Berlin, from office to residential, quarter developments. That's what we are doing.
Okay, great. And do you have a kind of perspective on the sort of election result as a developer? Do you think there's going to be particular impact for you, whether that's an increased focus on sustainability, or I suppose what's your take on it?
Well, the last 2 to 3 days, a lot of movement has been there in. Okay, normally I'm loudspeaker. So no, there's quite a lot of talks around, and one very interesting topic, which would be very helpful for us, would be looking at the challenges we are meeting, we have to meet in the future. There has to be quite some changes to be made to get faster admissions, faster building permits, zoning permits, this whole structure. We have to really cut down on all those very time-consuming steps until you get what we call a B plan. For example, I mean, depending on the city, but we did just a zoning plan, I think is the right word in English, a zoning plan for a housing development close by. It took us 2.5 years. And that's just too long. It's got to really improve those measures. I mean, for example, where those big floods were, I mean, if you don't improve in that matter, there's no way they can rebuild the Ahrtal, because there's so many things that have to be done. Taking all the different considerations, it just will take way too long. We have to really cut down on our processes in that, and that is, from what I heard, one topic of the agenda where they really want to improve things in order to really get people, or in order to get the processes faster, and to be able to really set free residential areas or residential developments. And that is something we're really eager on. It's very costly, time-consuming to get permissions these days, and we have to really change that.
Interesting, thanks. And Matthias, just coming to you, obviously you're coming from the investor side, but also looking at the regulation there, and regulation has been mentioned. So I suppose, how are you seeing that, and do you think there'll be a different tone from the government after the elections, or what's your sense of that?
Yeah, to be honest, I think on one side, obviously, all political initiatives ultimately end up with additional regulations, and this makes us nervous. Yeah. So we need to have, for as well, the transformation into a climate neutral or carbon neutral environment, we need to have a lot of capital, a lot of innovation, and a lot of technology changes there. And obviously regulation is hindering that. So actually we need to have a step back, yeah, not only regarding planning permissions, but as well in relation to the financing of that. Yeah. So therefore, we like, as PGIM, we like very much actually the European regulation on ESG, SFDR. Whereas if you see what gold plating currently BaFin is doing, and the comments we receive from BVI, the German Fund Association, I'm rather happy that all my structures are based in London, or Luxembourg in particular, yeah, and not in Germany. So I get away from that. But definitely hindering developments into a new world of ESG. So that's definitely key. If I look into the programs of the political parties here, there's unfortunately too much regulation and too little, so to say, change towards less bureaucracy and actually freeing up the market. Yeah, I think we need a booster, yeah, and the booster in our environment currently would be freeing up the market again, which is a little bit counterintuitive for many, particularly the left-wing parties, yeah. But we could only manage climate change if we're freeing up the market and getting private capital into the right direction.
And does anybody else have a view, particularly on the election side? Any impact on the sectors where you're working in? Ingo, I mean, from your point of view, do you see any influence in terms of the financing side? I suppose, what's your take on financing at the moment? And do you think broadly that's going to continue irrespective of the government? What's your sense of that?
First of all, I'm totally with Matthias. I have to say, too much regulatory things we have to do every day. So we have to reduce bureaucracy, and I'm absolutely with Matthias. On the other side, I expect absolute stable market. We have a stable situation in Germany with the government. So I always say, as a German society, the German economy, it's like a container ship at full steam. So it's very difficult to change direction significant. So probably you would need more than 4 years.
Okay. And does anybody want to take a bet on what the coalition will actually be, or is that too tricky?
I think it's quite obvious that this will be Social Democrats, the Greens, and the Liberals at the moment. So,
is that on?
Looks right, and I think actually, if you see what they represent for, it's kind of social welfare, green, like the climate change, and the other side is the economy with the Liberals. It's kind of like what we had before as well. Yeah, it's, I think there will not be so much change actually. Yeah. Maybe there's a view that they want modernization. Everybody's speaking about this. Let's see if it's really coming. Yeah.
I mean, I think that the country, we all, and we are part of it, so we can do something as well. We all need a push. And I think that's what we, motivation, and yes, we need to get going. Also, we need to speak out what we think is necessary. I think that's, it's not only 16 years the same chancellor, but it is that we are. It feels that we were sleeping a bit, and that's not good. And that's something that we can change as well. Marcus, you're absolutely right. I mean, we need to go to the city and say, look, I mean, we need that permit, but a bit faster than you're doing it normally, and we need to address that.
I can see you itching to come in, Marcus.
Yeah. Possibly being too much an economist of this, I think looking back at the last 16, 18 years and what happened and what changed, and also the ambitions a lot of governments came in, I think right now with a lot of focus again on debt and government financing, I think regulation is for a lot of the politicians the escape route in which they can do something without spending a lot of money. And that is also, for me, a little bit of the worrying sign of it, because I think implementing new regulation is easy, but eradicating the old one at the same time is a necessary thing. And I think the second part is often missing, and we create an environment in which possibly the new regulation has a good intention and has a good idea, but as we don't eradicate the old structures, we get in an even more complicated way forward than we already had before. And so this is the little bit of the worry I have, that we also don't understand how regulations interact. We have put in so much new regulation over the last 5-8 years. Do really how they interact in a situation of crisis or distress or stress at the end? This is my worrying sign on it.
Yeah, perhaps Richard, one comment from our end is picking up the point from Carsten that if you look at real estate or real asset, however you comment, we are pretty relevant, from economic side, from an GDP perspective, etc. So we are representing as an industry more or less 15, however you calculate, 15 up to 20% of economic power. So I think it's also something to organize the issues we see and formulate it with the parties, and they are open more or less. Not, of course, they have their programs in general. And if you look at the big transformation which I had, the big CEO topics we see globally as PwC, it's about people transformation, and it's relevant, for us relevant, it's a hybrid work piece. How does it impact office? It's ESG and it's digitization. These are the three topics every CEO around the globe wants to speak about. And I think we have to just articulate because we are relevant in the economic wise.
Okay, good. I wanted to pick up a little bit, and feel free to come back on anything in terms of your views on the election and what may come forward from that. But I wanted to take a little look at the outlook, particularly. And let's pick up maybe with you, Oliver, in terms of the financing side, and I'll come back to you, Ingo, as well on that. But I suppose, how are you seeing the market now as we're coming through Corona to a certain extent? So how are you seeing Germany at the moment in terms of the financing side, and how do you see it going forward?
Well, I mean, just looking at Ingo, I don't, as I said earlier, I don't expect a big financial crisis. But if you see what the European Central Bank is expecting on new NPL ratios, it might go up from 3.1 in 2019 to almost 5.7 in 2024. There is a need to deal with NPLs and with distressed loans, distressed assets in Germany. And I think the world has changed in dealing with those assets. If I look around, I see at least 4 veterans from the first NPL wave in Germany, and back then our main focus was to make money, to get this 2 times multiple return, which meant to be very hard on the workout and foreclose on the assets and not deal in a very nice way with the borrowers, with the consumers. And this has changed. So if someone like Ingo and other banks have to sell loans into the market, there's a need for a new investor and for a new advisor with deals with working out loans or dealing with consumers under this ESG flag, as you mentioned, going into the market, providing new liquidity into distress situations, being very discreet when buying loans, so that we protect the reputation of the banks who are selling those loans, and not being on the Bild-Zeitung, there's a new cowboy in town and working out loans. So this is, I think the whole world has changed. You have to provide new liquidity, but in a ESG compliant way. You don't have, the biggest problem right now is that everyone knows that ESG is big, but you really have to live it. You can't just tell you are ESG. You have to provide really concepts to work on those issues.
Okay, good. And Ingo, from your point of view, I suppose how have you seen the bank's strategy change in terms of ESG, and also any views that you've got in terms of, I suppose, what you are financing, what you aren't financing, and what the position is generally?
Yeah. I always have to think about something Oliver Bethge, the CEO of Allianz, said a couple of months ago, when he said he wants to reduce 30% of the office space and 50% of business trips for the Allianz Group. And this is something what will have an impact if there are enough companies who will follow this strategy. And this, to answer your question, is something what is very important for us during the approval process. So we really take very close look onto when we, for example, when we are financing office space, on the board, on the financial background, on the tenants, and so we are financing office, but with a very close and look onto the things I've just mentioned. We are keen on financing resi, of course. Logistics these days, very hot market, very interesting. And our attitude to finance hotels right now, standalone, is, let me call it, restraint. So, but I think this is the average opinion in the market right now regarding the financing of hotels. So, and this is coming back to the quote of Oliver Bethge. This is, nobody knows what the future will bring, but I think maybe this will come to an impact we will see and feel in the future.
Okay, interesting. Christian, just coming to you. I suppose, what's your perception on the market at the moment, and where do you see that moving? And you can pick up sectors or cities, whichever you prefer, really.
Yeah, that's a very broad topic. Let's pick some sectors. Well, I think the main question that many people talk about is where is pricing going? Where is it at the moment? And I think also many people expected during COVID that there will be opportunities to buy on the cheap. I think this is something that not really materialized. Most of the sectors sort of held on very well. If you look at the main sectors, office, residential, logistics, some sectors that obviously were affected by COVID, like retail, hotel, had a different story, and I still see the hotel sector as non-existent at the moment. And this is also a topic for retail. Some parts of the retail sector don't exist, of the investment market don't exist in the moment. On the other hand, I talked with many retail owners, and some of them used the COVID crisis for getting rid of tenants they didn't like anyway, and prolonging leases with tenants they liked, also on the cheap. Because usually if you have a Kaufland, for example, if you want to prolong with the Kaufland, then you must offer heavy terms. This time, people were negotiating with the tenants and saying, okay, look, you get a couple of months rent-free because of COVID, but then you prolong for another 4 or 5 years or so. In the end, it was a win-win situation for a lot of people. If you are looking for value creation deals in Germany, I think right now you need a development component in your deals. If you're outside of the super core or core investor universe, there must be a development component. Otherwise, I don't see how you do double-digit returns. And there's another niche, I would say, for portfolio transactions above 400, 500 million, because there's not much competition in that bracket in Germany. If you're able to deliver quickly and close quickly on a deal, you have the opportunity to do very good returns. And that's across the major asset classes.
Okay, good. It'd be interesting just to pick up on that retail point with you, Stefan, and anybody else who's got a view on retail. I'd be interested to hear that, positive or negative. But Stefan, just picking up on that point, I suppose, how do you see retail? It's obviously had negative tailwinds for some time, heightened by the pandemic for certain and the sort of take-up of e-commerce. How do you see that now, particularly here in Germany, and how do you see that moving forward?
Yeah, so perhaps I can even link it to the election. I think my first impression was your introduction statement is what I shared as well. It's not too bad, the outcome. So we could have had a left, green, and I think that might have presented a number of challenges to different sectors. And Christian, I also think we have a slightly different element in the current coalition and the current discussions, because the liberals, who stand in Germany for the free market and favor the free market over the hand of the government, the liberals are part of the discussion, and I speak for retail. And the retail sector has suffered from severe lockdowns, and we all have learned how to work and live with these lockdowns, so essential retailers could open, non-essential retailers were forced to close. But it's a political definition, what is essential and non-essential. It is also a political choice whether you go for the direction of locking down the economy and the society and certain sectors. And I'm quite relieved, with a view to this autumn and next spring, that we have the liberals as a major part of the discussion. So we have not sold one retail asset last year. Our transactions were all aborted, all parked. And it's reasonable. So there's no debt finance available for a retail transaction unless you are hypermarket anchored with a 15-year lease to Kaufland, Edeka, which were the essential retailers, but there's a major part of the market which suffered, clearly suffered. There was a wave of retailer insolvencies, which also raises doubts. We think of the insolvency of the largest department store chains that we have had in history in Germany, and that presented an issue. So there's uncertainty in the investment market, but I personally think we won't have another lockdown. I think we are, with the vaccination programs, we have made very good progress. I think that the retailers have made very good progress in operating their sites in a way that it offers a safe shopping environment. There have not been any super spreader events in Germany triggered by essential retailers that have been open throughout the pandemic. So that should encourage us to think, hey, perhaps there are concepts that work even with the infection rates picking up over winter, what we expect. But perhaps we can leave retail open. I believe that will happen, and I personally hope that the liberals will, raise their voice when there are other voices in this respect. So I can share, but I can't share a lot. I can share that we have signed 3 transactions this year. We have signed one 60,000 square meter plus shopping center, which is between signing and closing at the moment, an added value deal. And the capital comes from outside of Germany. And the bottleneck, the deal pens between signing and closing, and the bottleneck is debt finance, because there is equity for added value returns in the market. There is debt finance available from senior lenders, and very renowned houses are providing debt finance to these transactions, but there are enhanced equity requirements, and the banks are not willing to extend their loan share so that everything ties in. So how do we solve that? Debt funds from outside of Germany, who come in and lend you money for 2 to 3 years to finance your acquisition and bridge the situation until the German lenders may feel more relaxed about that and come back to the market and may be willing to extend their share as well. So that is one thing. The other thing is a mixed-use property, which is also pending between signing and closing due to a Corona-specific clause that was agreed because the purchaser wanted to have certainty over a tenancy situation. And the third thing is a hypermarket anchored retail park, which goes like bread and butter. And we've just signed a couple of weeks ago, but that means we've signed 120,000 square meter retail GLA. There are transactions in the market.
Good. Just it'd be interesting to pick that up with you, Christian, from kind of Collier's point of view. I mean, obviously, there used to be a huge focus on fashion retail, and nobody was that interested in, or nobody was very excited by food-anchored retail and those kinds of things, and essential retail. But there's obviously been a huge change around over the last 2 years. I mean, is that going to continue, or does that mean, from your point of view, that there's now a big opportunity in what would have been traditional retail that everybody wanted to get hold of? How do you see that retail side?
In both ways. So what we also saw that, for example, the food-anchored retail, and we sold a couple of those before Corona, and if we compare the prices now, we are kind of like, I would say, at least 50, 70 bips now down the cap rates. So this is kind of something, of course, in a situation where you are confronted with kind of like lockdowns and you see all the hypermarkets are open, that's a safe product. The ICs, they see this in their private life and say, hey, buy this stuff. And so there's more pressure and the prices went up a lot. I also think that, especially like what Stefan's products, the big shopping centers, that's the biggest opportunity at the moment in the market. And I think also like from the debt side, it will be foreign capital running into this and seeing that there's a big opportunity. At the moment, a lot of like the domestic investors are shy and don't want to go into this field. So this will be an interesting market definitely next year if we don't have any lockdowns anymore. So I fully agree on that. Maybe just also to comment on the office side, which was mentioned here by Ingo before, we see that kind of like the recovery is coming a little bit again from the letting side. We had a number of larger occupiers also signing, and if there's progress going on. So we think it's improving the situation. We also think that even if you have kind of like remotely work from home ratios at a certain extent, you will need better quality space, you will need more common space, and kind of like an environment which makes it attractive for employees to go into the office. So we don't think that there's such a drop in the absorption actually in the office sector, and we're at the moment at about 4.1%, top 7 vacancy rate. This might increase a little bit, but not that much anymore. So we are still compared on a European basis at the lowest vacancy levels ever. And I think it's a good environment. If you see, we have from the OECD forecast of about over 4% for Germany, which is fantastic. We never had such growth expectations before. This can be short-term a very interesting market here, and there's also more capital to come. The domestic capital is anyhow here. They're under pressure. We saw it from Marcos. They have to go in alternatives to anyhow reach their yield goals. I think it will be. I have a very positive outlook for this. I think we lost again 3 months this year, so the total volume will be not that exciting, but for next year it looks very good.
Okay, good. Marcus, I know you'd got a view on retail, which you didn't include in the slides, but it would be interesting to get that. And then, Carsten, I'd be interested to get your point of view as well from the Carlyle Group, just in terms of some of the other sectors as well, and your kind of general take on the market. Marcus?
Yeah, I think what we can say about retail, I think overall the pandemic has been a huge accelerator of structural change that was already underway. I think retailers had to reassess their store networks before pandemic, and the pandemic really laid bare the issues they had with too large store networks possibly. But I'm a true believer that stores will be there in the future as well. They are needed for the retailer. So can someone imagine an inner city of any city in Europe without retail, physical retail stores? I think part of the physical retail will always be there. The only question is, what is the role of the store, and that will change. Retailers will see they have a showroom. Part of it will be a logistics hub. Part of it will be an administration area for administering returns and possibly being a pickup point or whatever. So the role of that store is changing, and therefore the pricing from the retailer side is changing. They are willing to pay only lower rents, because if it's a logistics space, you won't pay the rents you paid before possibly, but you will still need that space, and I think we will have to learn and adapt to this new normal. And I think that is the time we need. And what the other thing, the attraction of food, it's simply that we learned that it's quite resilient. It's a little bit of similarly boring like residential, because if there is a crisis, you need food, you need something to eat, and you need some place to live. So these two segments are quite resistant to a crisis as long as the income level is supported by the social system in a country. And this is the attraction, because the investors like this kind of boring stuff to generate the income. But they will return to high street retail and shopping centers. The only thing is we have to figure out what is these new rent levels on which the market will settle. And I think this is the big challenge going forward, that we're in the process of learning what rent levels will look like.
Now, that's interesting. Does anybody else have a view on that? And then I'll come to you, Carsten.
Oops, sorry. Okay. Well, there's this.
That's fine. We can. Yeah.
Maybe one more thing that besides settling on new rent levels, we do have quite a challenge, I think, to meet. How will our cities look like? I mean, looking at the tile, what you said is perfectly right for basement, the ground floor, maybe first floor, but what's on second or third floor? That is a big challenge. I mean, that's what kind of use do we have there? Residential? I don't know. Logistics part, that's a big challenge. I mean, especially if you're going into transactions. If you think about maybe buying one of the department stores, you don't know what your neighborhood will look like in 5 years. That is a major risk. You can come to totally false assumptions of what's going to happen, and especially now here in Frankfurt with a city authority which is finding themselves right now. You don't have no clue what their plans are. You really have to see what will the face of the inner city look like. And I don't see any answers worldwide at the moment. There's like a golden line, okay, do this and this and that. Because residential in the city didn't work so good lately, at least as I found it.
I think what we need to do now is really approaching the next level of smart investing, as well in particular regarding the due diligence you're doing. In the past, we looked into the tenants and the financial performance and stuff like that for a tenant. And we said, well, this is a great tenant, paying their rent, that's fine. But now I think we're much more looking into, hey, what kind of business model do they have? Will they be around in 5 years from now? Is it really resilient? Yeah? And then it's actually not only retail which had this challenge where there's a change and we think, okay, going forward, will those guys now be replaced in 5 years with an online store or move away? Or do they have a smart model about replacing traditional retail with a smarter idea, showroom style more, and all those things. And it as well, it affects as well office rents and office tenants. Yeah? You look into how far are they with their working from home policy. Yeah? Have they developed something which is smart where we think, okay, they will be around and taking actually the same floor in 5 years from now. So this is actually now expanding really the role of due diligence and looking into tenants, which in the past you didn't really look into that, to be honest.
But you were under some kind of pressure. So if Ingo gives me a loan and I have the fear of running into a covenant breach, I take on whatever tenant I have without doing a detailed due diligence on the tenant, whether the business will work in 5 years down the road. So this is, where the conflict might be.
I cannot add that much to retail. We have exited our retail deals where we had significant retail exposure in 2016, 2017, while we are seeing that the sector is running into trouble. We have only a small commitment in France, but more the bread and butter business of retail parks. But I agree with you, the business model will be more and more important. And I think that's a kind of true for each type of the tenant. So we are doing more and more due diligence on the tenants, but you're right, you need to be in the position to do that. When you're under pressure, you probably take what you get. Yeah? And just a little comment on the banking side. What we are seeing in the market is that whether you have an asset where all boxes are checked and then Ingo and all of his competitors offer you a loan, or you have an asset where one box is missing and none of them is looking around and offers a loan to you. And this is where all the alternative financing providers come into the game. It's not our fund. Colleagues of mine also raised the fund, being active in the sector. We have a good number of assets that we financed with alternative debt providers. Of course, the margin is a bit higher, but they are usually more flexible. And I think this is a very interesting point. What I see in the banking sector at the moment is that there are just pushing or accelerating the cycle with their way of agreeing on debt or even not. And I see this as a huge problem for the next couple of years.
So there's in essence a debt gap for some of the assets that you might want to.
I wouldn't say a debt gap because many players will just only do that what is in a normal market financeable. But usually we try to think a bit outside the box. We take operational risk on board. We create operational platforms. And as soon as you do that, there is pretty much no financing in the usual debt market. For example, downstairs, you all have seen the WeWork downstairs. We operate a platform in London which is called Uncommon, but we own the asset. And if this would be an Uncommon asset, then at least 50% of the office space would be operated by Uncommon. And this is our answer to office. On the usual office investments, we are pretty selective, I would say.
Okay, I'm going to come back to office in a minute, but I'm quite keen to pick up on the alternative side. I know it's only slightly alternative, and you may object to that, Rainer and Philip. But obviously, a lot of focus, a lot of capital, as Marcus mentioned there, and a lot more capital beginning to move into student housing, micro living, and also particularly the healthcare side. Maybe let's start with you, Rainer, because it would be interesting to get an update on what you're seeing, both in terms of the student housing side and particularly with terms coming back in the markets where you're operating, and what the position is there.
Well, I think it's pretty obvious. The markets we are operating in, we are pretty much linked into the resi sector. And if you take Germany, for example, over the last 10 years, residential sector here has become more and more dysfunctional for various reasons. If this correlates with an influx of international students plus domestic growth, the situation becomes a tense one. To give you one figure, 10 years ago when we started on the student housing side, the number of students in Germany was roughly 1 million. We are now north of 2 million. And the sector, the private sector, in addition to the public sector, counts currently 50,000 beds, something like that. Meaning the rest, or at least the biggest part of the rest, which is seeking accommodation, has pushed into the resi market and has further imbalanced the situation between supply and offer, has seen rents rising and all the typical aspects that we know about resi in Germany, which is also the case in some other continental European market. And making one link to the elections, I think there is some fear of further rent regulation rising, which has a ground because regulation is easier to implement than boosting investments. But it's also on the processes that we see, and we are applying for building permits as well, and we see a lot of municipalities still operating on paper, which makes people move 20 kilos from their office to their home office 2 or 3 times a week to be able to deal with an application. But this is only a side comment. Yeah? So we need to come to a framework which allows the resi piece in Germany to grow stronger, and which embeds this into a procedural and processual landscape which needs to be way more innovative than it is currently. And this brings me back to where are we now on the student side? Yes, a lot of doomsday prophets last year predicted the end of micro-living and student housing due to the pandemic, which interestingly or surprisingly did not happen. And we managed quite well the crisis. As everybody else, we had to implement health and safety concepts and things like that. We had to deal with lockdowns and so on. We have seen all universities in Europe going online. But everybody has survived this and in a way better shape than publicly expected. And now we see a situation that some 50% of the class of last year, first-year students who have stayed at home, are flooding the university spots in addition to this year's first-year students. So whomever I talk to in Germany, in the Netherlands, in Austria, they're all full. And they are full at the point in the process which is 6 or 8 weeks earlier than regularly. And this is already the situation in the absence of true internationals. So China, for example, due to travel restrictions and visa restrictions, they are currently not present. Yeah? But we see massive traffic from Spain into the Netherlands or to Germany, or even we run a scheme in Prague, which is fully booked with young people from 40 different countries. Yeah, so there is let's say, a very, very strong movement now after being locked in and locked out and locked somewhere for 18 months, yeah, to go back to normality amongst young people. And going to university is an essential part of the socialization of young people. And I think it's quite obvious that all these trends or the discussions that we had similar to office, whether home or presence, can this be applied to universities or not? Will all lectures in the future be online? No, it will not be. We know now that as a backup it works. We know now that it can be an addition to procedures. But the universities plus the young people are desperately seeking to go offline. And bottom line, my take is, yes, we have adopted some of the business models for learnings out of the pandemic. But the sector, especially in dysfunctional markets, and the number is growing in continental Europe, has a very, very strong fundament going forward, and that also attracts a lot of international capital. And my take would be the sector in Germany is 80% financed by international capital, at least on the development side. If that then develops to core, you see pensions and others coming in. But let's say the first 2/3 of the cycle is definitely international capital. And as the UK is a strong market, but maybe more on a plateau as regards supply-demand ratios than most of the continental European market. Those international sources are now looking for entry points into continental Europe. And the last 18 months have not been helpful for them because, as Markus mentioned in his presentation, looking at transaction volumes, we have also seen that on student housing and micro-living. We personally have done a lot of transactions, but I would say a certain chunk of that we have done due to the absence of others, and it's now reviving. Yeah, and it's a strong, strong fundamental going forward.
Okay, good, interesting. And we can pick up on any views around that. But I wanted to bring you in, Philip, just on in terms of your sector, because again, there's been an increasing focus on that sector as well as ESG, actually, but particularly on the sort of healthcare side, over, well, it's been growing anyway, but certainly over the last 18 months. So what's your take on the market?
I have to say, focusing basically entirely on the healthcare sector, I feel that currently I'm sitting in my little happy place because I think lots of the question marks which we've got on other asset classes like office and retail. I'm not saying here that they're done. I think that they're just changing, and people are thinking about where things might go, or like we talked about, whether values will correct, whether you're going to have a negative reversion if you buy today. And I think, this is basically driving people to alternative asset classes, which are based on other drivers, but economic drivers. Because basically our main story here is demographic growth. In Germany, we're an aging population, a growing aging population. We've got now all the baby boomers, which are the years 45, 46, basically coming to the market. They're now turning 75. So it's a huge demand, which is basically going to be created over the next years, and supply is still really, really limited. And the example I always like to give, because it's just giving a nice picture of where we stand today here in Germany, is basically the requirement which we're going to have for for example for care homes in Germany over the next 8 years until 2030. We're talking about 250 to 285,000 beds which have to be created still. And if we're considering that, an average care home has about 100 beds, that means basically one new care home has to be built every day for the next 8 years. So there's a huge potential of a new upcoming market. It has got its challenges, of course, as well. But at least in terms of the demand side, it's something very, very solid story which we can build on, and which is then of course driving investors' demand on our side. Plus, we're ticking a lot of the boxes which Markus talked about. So people going into core investment, people focusing on ESG. ESG is something which comes rather natural, of course, with that asset class. So it's really a little bit the flavor of the day. So it's helping us and giving us a lot of tailwind, really.
Yeah, go ahead. Yeah.
It comes back to what Matthias said. Just we have to think the industry a bit different. We have to think what do the customers, and ultimately customers are the people using the space, actually need and want. And so that certainly kind of applies to the last two. They need a proper home once they're older, and proper probably means something different from what we see today. Some of these homes are not what people want. This is why they don't go there. They're poor. Mm-hmm. And the same is for student housing. Obviously, we're social beings, so we want to go somewhere to meet other students. Actually, the same applies to office, because maybe some of the people interviewed were a bit too high in the ranking. They had nice houses and towners and enjoyed being with the family, which many of us did, and it's good that they did for a couple of weeks in the lockdown. But the real need of the people working is that they want to see their colleagues, because their colleagues becomes friends and stuff like that. So it's the social environment that people actually want. These are the customers, and I think they are ultimately more important than the tenants on the long run.
And I'll come back to that topic. I just wanted to pick up a little bit with you, Tobias, in terms of the capital. Rainer mentioned there that there was around 70-80% of the capital was international. Marcus also mentioned that obviously over the past kind of 12 to 18 months, a lot of the domestic German capital has been operating in Germany. I managed to get a flight and successfully arrived. So are we beginning to see more international capital coming back again? What's your sense of that? Or did it never go away? How did you see it?
As long as these international capital providers also get fuel to get to the airport, then I'm sure we will have international money in Germany. But I think I have two hats. I can wear two hats on this question. The one is me being a broker, where I see we currently market a city-centered development, high quality. There's almost no interest from international investors, but heavy interest from domestic investors. When you look at that's the one thing. High quality products, I do not see too many international investors, but we also currently market a parking garage, not in the city center, but somewhere in the outskirts, on the other side with a high quality, more or less AAA tenant. And for this type of property, there's almost no German money. I thought when we started it, I thought this is the perfect Sparbuch for family offices or high net worth individuals. No, they all said this is nothing to preserve our wealth, so we're not interested. But now the bids we have on the table, they come from Israel, from London. So I think it depends on what type of product you're marketing. And then another head is when you look at us being developers. Last year we bought a property in Fürth near Nuremberg, and we talked to a couple of international debt providers, and for them the ticket was too small. And since it was non-food anchored tenant, they said this is nothing we want to do, at least in the pandemic. So your question, there is still international money around, but given the fact that there were these travel restrictions, I think they will come back massively next year.
And has anybody else got a view on that in terms of, I mean, obviously, Carsten, you'll be seeing it coming through, bids and offers coming through, and I guess as well, Marcus, you'll be seeing that from a development point of view in assets that you're selling, for example. Are you beginning to see things coming through? Is anybody seeing that? I mean, Carsten, what are you seeing as well? I mean, are you seeing more interest in the market from internationals?
We see clearly more competition from internationals. And by definition, we might be international capital, but we have, of course, on the investments that we did in Germany, we have a very local view. I'm the boots on the ground here. One of my colleagues who does it together with me, we have a very local view. And then the question is that an international mindset? At the end of the day, yes, because the decision is taken in Washington, but they're listening very carefully what the locals are saying. And coming back to the point, yes, we see more competition, and I would say, maybe 6 months during the pandemic where there was less competition. And we did some deals during that time, so we took advantage of it. And as of today, they went well.
And but you're definitely seeing more competition coming back into the market now than, say, 12 months ago?
I would say yes, they're already there, in my view, or already back. Yeah.
Everybody's seeing that, yeah.
I'd like to add one aspect. Sorry, my name is Sönke.
Welcome.
From Savills Investment. Just one aspect. You touched it in the beginning with the elections and more or less a big or smaller green shift. And what I see from the assets we are selling, we have, and also those assets that we try to acquire, those assets that are core, that are new, that fulfill ESG criteria. You see lots of domestic investors running for it. There's a big competition. And then other assets which might be 20, 30 years old, speaking about office assets in particular, there's not that much interest from domestic investors, at least from my experience, and that's where the international investors come into play. I don't know exactly why. It might be that the regulatory requirements are a little bit different from there.
But they're back in the core sector as well, international investors.
Also,
and that's not only the value add sphere. They're surprisingly very fast. They came back to core sector as well.
I can add on this from Sönke. So same what Tobias said. So the value add part is very focused from international money at the moment. The core stuff is rather from domestic money. And why is that? Because we are at a yield level, which of course in an international comparison is not attractive. Buying something at 2.5% is quite difficult to tell somebody from the MENA region who is used to 6 or 7% core cap rate. So this is, of course, the result. And I think if you compare this, of course, normally you always had the argument, okay, you get very cheap financing, and that's why your total returns are much higher. But if there's something below a certain level, let's say 2.5%, then even the financing doesn't bring such a leverage that it's attractive for example, Korean capital or something. So that's why we see less of that. And I think with this outlook I gave before, I think for the next year, as this is so positive, I think there will be a little bit more shifting those normal core-oriented international capital more into this more risky things. So we will see more of the international capital. And just to add the stats on that, the first half of this year we had about 30% international capital, usually something like 45 to 50%. So it's much less, of course, and this was due to the restrictions which were told by Marcus before. So, but this will become better, of course, the next year.
Okay, good. Christian, I just wanted to come to you, and also Marcel, for any kind of views you've got on this particular topic, and also what you're seeing in terms of the, I suppose the investor intentions, and maybe it'd be interesting as well, Christian, just to pick up from you what you're seeing in terms of the cities, whether that's really a focus on, core in A cities, or whether people are looking at B, C cities, particularly with that idea of that maybe people don't need to work necessarily their whole time in major cities. I'm wondering whether there's any change there at all in the German market.
So far, I can confirm that we're seeing international investors being back, which were literally held back by quarantine restrictions, etc., over the past months. When the restrictions fell for the UK, for example, we saw immediately a wave of investors coming over from London, touring offices and doing site visits in Germany. If you ask me with regards to home office, etc., we at Waterway, we don't believe in a future for home offices. So we strongly believe, as Carsten said, people rediscovered the office as a location for socializing, for meeting their colleagues, for exchanging ideas, etc. And also, I think many employers also realize that there are productivity issues if everybody is at home in the home office. And we also saw that when hiring people, interviewing people, we were asked, do you do a home office or do we work in the office? Because they said home office is not an option for us. So we saw that from the other side as well. When it comes to your question regarding the investment locations, we definitely see a concentration on easier to explain cities and locations at the moment, but that doesn't mean that non-core locations and or B or C cities are totally out of flavor. It's the other way around. So the main investors are going to the, let's say, top 10 cities, but the B and C markets are still also very healthy.
Okay, good. I wanted to just pick up briefly as well, just on areas like data centers. I mean, if I looked at the ULI kind of investor intentions from last year, things like data centers were right at the top. But obviously a much smaller area, for example, and we're certainly beginning to cover a lot more in terms of data as well, that crossover between infrastructure and real estate, those kinds of things. But does anybody have a view on those kinds of more niche areas like data centers? Yep, Christian, go ahead.
I'm happy to. So what we see at the moment is that especially ground sales are increasing a lot in the data center sector. If you take the existing buildings, there's just a tiny market. It's really niche. It's maybe 200, 300 million at max. You get on transactions per year, so that's not much compared to the other asset classes. And also interesting from the local concentration. So if you see Frankfurt is the 5th biggest hub for data centers in the world. I mean, I've looked at the figures. I was really surprised and saw that Singapore is 8 and Hong Kong is number 10. So, which is interesting. Virginia is kind of like number 1 here. So, which also maybe nobody expected. Rather California, but so this is Frankfurt is very important in Europe, and there will be the biggest problem, of course, they're faced with is power. They don't have enough power to build all that they would require. So we saw some movements, for example, from the surrounding areas of Frankfurt, Mainz. They now bring something into space. I think there will be more activity around Frankfurt probably in this field.
You want to pick that up, Marcus?
Yes, Richard. I think what we have, these kind of niche or alternatives, as in the US they're often called, I think we have seen that trend. If you look at the US over the last 10, 15 years, we have seen that these kind of alternatives had a very strong run, and they're today a substantial part of the real estate universe in the US. I wouldn't say we see that one-on-one development in Europe, because I think there are structural differences, like cell towers will not be a market in Europe as they have been in the US. So I think imagining investing in cell towers across Europe or even in Germany, that there will be regulatory challenges on this. Nevertheless, I think whenever we look at these alternatives, the big challenge is compiling a large enough portfolio to profitably manage. You need the in-house knowledge to run all these things, and you have no existing liquid market to gather, to agglomerate, to really build up the portfolio. So you also need to develop them on their own. And I think that's the interesting part, what we also have seen in the US. They have been mainly created by the listed sector that have discretionary money, and they're able to really quick and fast implement their strategies. With a lot of the structures we have in Europe with non-listed real estate vehicles with limited discretion on their investment decisions, it will take much longer to see this happen, I would say.
Okay, good. Does anybody else have a view on that? On the financing side, is that something that anybody's active on? Ingo?
Not Münchner Hypothekenbank. It's nothing we see in our lending strategy. We are tied to the Pfandbriefgesetz as a mortgage bank, and we always have to have in mind that the space can be used by third parties. So this is something very difficult to finance for a mortgage bank.
Okay, good.
I think speaking again for the healthcare sector, I think financing is becoming a less and less an issue for us. It might have been in the past because the operator market has been so dispersed. There have been a lot of small operators, so there's been always the question on their credit rating, how sustainable is their business. I think this is changing now with lots of bigger, more professionalized operator basically evolving from mergers and acquisitions. I'm not saying that these are necessarily the bad operators, so gotta be careful what I'm saying here, but at least, there's a certain level of professionalization in the market, so I think that's helping us. Plus, most of the banks which we're referring to when we're financing these sorts of assets are actually the local banks which understand their market. So, if we're talking about saving banks, etc. So I think they're always quite favorable in terms of financing these assets, and in terms of financing conditions, it's actually quite favorable right now.
Okay, good. We've got around 10 minutes left, and I'd like to kind of get a last word from everybody on your views of whether you're your glass is half full, half empty, whether you're more positive than you were before the election results, how you see that, more positive in terms of Germany or the same, and both in terms of the outlook. So why don't we start at this end with you, Christian? Just, I suppose, how are you feeling in terms of the plus or minus, more or less positive, and also, I guess, if you want to, where you see opportunities going forward in the market?
Okay, so I would definitely say it's more positive than let's say 12 months ago. We're pretty bullish when it comes to the fourth quarter and next year. I think many investors are restarting the activities only now, and we think the transaction volumes will be back starting Q4. With regards to the political situation, it all depends on who's becoming chancellor and who's doing the coalition. I'm with Christian Kardel. I see the Social Democrats as the party to go. What will that mean? Let's see.
Okay, good. Marcel. Michel, sorry, did I just say Marcel? What am I talking about? Michel, what's your kind of take on, and you can pick on either your take on the election or where you see the opportunities in terms of the market going forward.
Yeah, sure, thank you. I mean, the market evolved in a direction that we didn't know before. It's some kind of modern lifestyle getting now. I learn every day now a new point of view of a colleague, of a friend, or of a business partner, and I think that the market change also on the real estate side on that direction. We need to adapt it to that view basically. What we see now is a more appetite for the moment at least, for the real estate investment side in Germany at least, and we Arcida do also expect now the more challenging issues out of the market that have been basically hidden over the last years coming out now, like the NPL sector, or at least the difficult assets that nobody wanted to talk about. We need to find, of course, a new strategy for that, but this is more the aspect on the asset management side. I mean, the market will grow up. And even if I'm expecting whatever direction of the election that will raise to Germany, I think the market will grow up on a direction and will adapt himself basically to the political situation. But Germany is really a good market, a strong market. It used to be the case all the years before, and I'm sure it will remain the case.
Great, thank you. Carsten, what's your take on the opportunities as well?
If first start with the political situation in a world with a lot of uncertainty, in a way Germany has voted for continuity, whether it's a coalition led by the socialists or by the conservatives, it doesn't really matter in my view at the end of the day. On the investment market, we have a very positive outlook, at least for the next 15 months. And we all know there is a lot of capital out there, so competition will be tough. The question is where to find returns, and this is a real challenge in the market.
Okay, great. Your take, Matthias?
I'm very positive, actually, because I think there are many different transformation processes currently ongoing in the market, and we touched on most of them. We touched on ESG, which will trigger a lot of transformation. We talked about changes in the office market, working from home, retail markets, changing to Corona. And we now see as well, after 16 years of Angela Merkel, something new, which ultimately will lead to a transformation as well there. So all those transformation actually creates opportunities, allows new investments. So actually I'm really positive about this, because always changes creates opportunities. Of course, risks, and we need to manage those. But on the other side, I see more opportunities than risks actually in the current market.
Great, thank you. Stefan?
Well, I'm not bullish for the market as a whole. So there are definitely complexities. Retail is a changing sector, and people have to work on their assets, and there's a lot of asset management activity ongoing, and that will continue for a while. We think in the hypermarket anchored bread and butter sector, yields will remain sharp, people will invest a lot of money. That definitely, but where it becomes very interesting now is, and I think, Christian, this is probably what you also commented on a minute ago, is that cap rates have moved out in the last 24 months for shopping centers, for example, or for larger retail properties, and meaningfully. So if we look at the fiber charts, we will see that retail shows 5+ cap rates, even for very, very good product. And this is where the occupiers will turn to as well, to the very, very good product, because they will run their local stores. They only will not run 4 stores in the same city. They will go to the very best product in the city. So this is why we think people will now try to pick up the top assets and just have the benefit of picking them up at a, at a price level that is relatively to other sectors attractive, and relatively to historic cap rates attractive. And this is where we see both, actually, Richard, domestic and international people coming to asset tours again.
Great. Marcus?
Yes, having said at the beginning that I think regulation is on the horizon, I think what the other thing is what Germany can possibly benefit from is that politics is the art of the compromise, and given that 3 parties have to govern together now, they have to learn finding a compromise with a certain goal they want to target for. So I think there is the opportunity that we possibly get some goal-oriented compromises that in a world of a lot of red lines in the past, where people will learn again that the compromise is something good and not something bad, that nobody lost simply because of compromise. Because I think that is the big danger I see, that someone who going for a compromise seen as a loser. And I think at the end that can benefit the overall, if more compromise is reached for a certain goal, that will also help the real estate industry, because going for the extremes in a lot of topics, might it be ESG or whatever, will at the end not help us to reach that goal any quicker. It will only increase the challenges for the whole industry. I think understanding compromises and finding them and enabling also technological change in real estate will help. And therefore I'm quite positive on most of the sectors, even on some of the, as mentioned, with these kind of retail that it's people shied away of. I'm quite optimistic that they will return. The only question is, how will retail look like? How will the physical asset look like in the future? And this is what we have to figure out. But there will be opportunities for sure.
Great. Carsten?
I'm actually super positive as well. I mean, for the real estate industry, the interest rates are low, they remain low. There's no way that it will change, so that drives money into our markets, and there's no bond market as discussed before. So I think that's positive. From the political situation, I'm rather positive as well. Looking at the photo that we just saw this morning, that's a sign of positive energy and willing to find a compromise and to talk. It's probably the best photo I've seen from politicians for quite some time. So that's nice to see. And I think that's what the vast majority of the population wants. They want some change. They want people moving. They want energy, and that photo is energy. So that's good. And I think for us as experts, it is actually quite good that it is not easy. So everybody could do it if it would be easy, but it's more complicated. It's operational. We need to think about it, and we need to think from the customer end. So I think, yeah, we can do it. We should do it.
Great. Christian?
On the politics, if you compare Germany in Europe, it's the country with, I think, with Switzerland and Belgium, the one with the most MPs from the Green Party. So I think that forced all other parties already to push this one. So now, even if they get part of the government, but the other ones are on this way as well. So I think it's very interesting. Everybody, all our clients, they're very focused on the ESG issues. So if you want to invest in Europe, I think Germany is the one driving this the most, will be the most in the next couple of years. And I said before, from the outlook, more than 4% GDP growth is something we never had in the last 20 years. So it's very interesting, especially for international capital to go here.
Great, Rainer.
For the sector, I'm extremely positive. So are banks, so are investors, which is the fundament for us to grow to be an integral part in resi markets in continental Europe. And from a political point of view, I think, as mentioned before, it does not make a lot of difference whether it's the Social Democrats or the Christian Democrats being the senior partner in the coalition. The key driver will be to which extent the Green and the Liberals can be the driving force for the innovation and the technology drive that we need in this country going forward. And I think if you look at the structure of the votes, a lot of young people have placed hope, trust, and to a certain extent a bet on these parties. And if they tend to disappoint within the next 4 years, we all will suffer, but them especially will get the bill presented then.
Okay, good. Philip.
Well, Richard, I'm also fairly positive, of course. So my glass is half full. I agree with Carsten Creel saying, I think the challenge we're going to be facing is how we generate decent returns. But I think in this environment, and I think this is what I like about the current market, I mean, it's pushing people to rethink how they're doing business, to maybe challenge themselves, like we've been talking about different asset classes, etc. So rethink the way we're doing our business, and it's also a market, which is also rewarding professionalism, so people who know about their business. Like Carsten said, we're just no more just simply buying real estate and leaving it there, but we have to go into development. So I think professionalism is going to be rewarded in this part of the market. So I think there's still deals to be made and money to be earned. I think it's just pushing people to, basically rethink what they're doing.
Great, thank you. Ingo.
Regarding the real estate market, I'm absolutely optimistic. As Carsten already said, we have low interest rates. There's a lot of money in the market. I'm with Steffen as well. There's a complexity with some asset classes, and some properties will not find a classic senior loan, but there are alternative lenders who are probably interested in these assets.
Great. Tobias.
So, regarding the elections, I'm quite happy that we have seen the extreme left and right parties losing percentage. And either a traffic light coalition or a Jamaica coalition, I don't care. For me, as a businessman, I say this will bring stability either way. So that's about the elections. And I don't want to spoil all this and say I'm negative. No, I'm positive as well for the outlook, at least for those sectors I work in. Putting on the hat as a broker, I say I love to have more deals we did last year, because we managed to sell almost a handful of long-term to the government leased buildings. And in all of these cases, it was a police station, it was office building, it was an office development. We had the luxury of deciding between more than a handful of investors wanting to buy these properties, and of course at extreme prices. In one case, we exceeded the the minimum asking price by almost 10%. So that's my take as a broker. I'd love to do more of these deals, but there I sit in the same boat than you as investors. There's not that much of these properties. And changing hats to the joint venture developer, I would go into what we call stranded assets. A couple of years ago, we started initiating joint ventures, and we love buying stranded assets, buildings that are out of shape for whatever reason, buy them, refurbish them, and sell them again to institutional investors. Thank you.
Great, thank you. Marcus.
Yeah, maybe picking up or starting with the business side, I think the most difficult thing as a developer is just finding product. That has been the problem over the last 2 or 3 years. It's not a problem with financing, everything. That's something you can get organized. But how can you find a product where you can acquire to a price where you still can do your own business with rising building costs and construction costs, and still get a good yield out of it. that is the biggest concern I have. Basic economics, I think, in Germany are stable, will look pretty good. And coming back to the election, I think it's a very good thing that there will be some kind of change, whatever color we have, but it will be change. A lot of young people, that's what Rainer said, is very good that they voted for Green and the Liberals. They expect change. The whole country expects to a certain amount change. And hopefully we will be able to materialize on that, because there are quite a few topics where we need to do something, coming from a very strong and high level of already reached efficiency. So, but still, I'm positive that we will be able to meet the big questions that are ahead of us.
Great. And last word to you, Sam. You probably weren't expecting to answer this, but nonetheless, let's have your answer.
Yeah, sure. Last one at the table, so probably I agree with most of you. And there was one sector which I recognized that we haven't touched. That's logistics, and that's also my pick. I'm well aware that pricing has increased tremendously in the past month, especially since Corona breakout. It's a very comparable product. We've seen 25% in just those 18 months of price increase. Nevertheless, with the regulations, with the discussions about greenfields, not to seal them, about brownfields, it's foreseeable that there's a limitation of supply. On the other hand, you still have the demand from occupier side. It's not Amazon, that's just the tip of the iceberg. And that's why I'm going for logistics.
Great, thank you very much. Really interesting discussion. Thanks very much to everybody for your views. Thank you for watching this as well. And indeed, if you're watching it on demand, thank you for watching it on demand. Really interesting discussion. Lots of these topics we'll also pick up at Expo Real. We'll be running a whole program there on the 3 days and live streaming those as well. So do join us at Expo Real. And interesting that you mentioned logistics there. We can often tell by looking at the program where the sort of flavors are at the moment in terms of investor intentions. And we're running 3 separate sessions on logistics, also one on data centres, interestingly, one on student housing, one on healthcare and senior living, as well as those on Germany and the other sectors. But just interesting to see that, and also a very big focus on impact and ESG. So I think those will be key topics as well for going forward. Really interesting to get your views. Thanks very much for joining us. Thank you for joining us, and look forward to seeing you at the next event. Thank you.